So with the jobs report coming out tomorrow looming, the market kind of took a breather today. Things that went up came down a little bit. Things that were down went up a little bit today, and did so with small range and small volume. Volatility dropped significantly. So I'm going to break down a lot of these moves. The expectations that we've had heading into today, have they changed? Or are we still looking for the same thing? So I'm going to break that down using the market forecast and other technical indicators, and take a look at one stock in particular that really broke out, but it didn't break out too much. And how can we take advantage if it did? So let's go ahead and get started. My name is David Settle, and this is my market outlook for today, Thursday, December the 7th, 2017. Thank you very much for watching tonight. Welcome to those that are watching for the first time. Keep coming back for more. Subscribe to my YouTube channel. Hit that red subscribe button that's right down there below the video. Hit the thumbs up that's right next to it and tell me that you like today's video. So one click, easy way to give me some feedback there. Tell me what you're thinking. Scroll further down, comment on anything that stood out to you from today's video. And finally, in the video description, you'll see multiple links there. Subscribe to my email newsletter, my daily email newsletter for the market outlook, by clicking on the link that's in that description down below. Follow me on Twitter for more content in addition to these videos. You see my handle on the screen at DavidSettle42. You'll always see the market outlook tweet pinned to the top of my timeline there, so you can always find it. Make sure you like and retweet it from there. Of course, join our market outlook community on Facebook. You'll see the address at the top of the screen to be able to interact with others who are watching these videos every day as well, and be able to comment on what you're seeing there too. You'll see a link to join also in that description of the YouTube video down below. Click on that link, go there, and click on join the group and start to comment. All right, well, let's get to it then and take a look at the S&P 500 using the market forecast indicator here. And you can see here's our near-term bounce that we talked about yesterday. And again, not very strong of a bounce, a smaller range, not as small as yesterday's range, but still a relatively smaller range. The near-term line didn't bounce up very much, so it's still, what we have, 1, 2, 3 days now below the midpoint of the chart. Usually it's 1 to 3 days when you're bullish that you'll be below here between 20 and 50. Now you notice we haven't dropped below 20 on the near-term line, so the momentum line did, and that's why we have, the momentum line when it drops to extreme lows can signal a change in trend, and we got one. We went from a strong bullish posture, a change in posture. But we went from a strong bullish posture to a weak bearish posture right now, and it continues to be a weak bearish posture. I mean, look at the trend though. If you look at the chart, that doesn't look like a bearish trend at all. And so, keep in mind that we're talking about this intermediate posture, and that just shows just how weak this is. So, I mean, if you were bearish right now, looking at that chart, you'd be completely counter trend, because the trend that you can see, the trend is higher. We're getting higher highs, and as of right now, this would be a higher near-term low point that happens to be sitting at the 38% Fibonacci retracement of this near-term rally, this kind of blow-off near-term rally. So there's nothing about that says bearish, and that just reiterates how weakly bearish this current posture is. But it is bearish nonetheless. And again, we don't go from strong bullish to strong bearish. We start off weak. And as of right now, you can see and strong bullish trends end with weak bearish postures. So, considering again we've been 3 months into this bullish rally here, since the intermediate line crossed above 50 at the end of August, we're going on 3+ months here of bullish rally. Again, strong bullish trends end with weak bearish postures. It doesn't turn, these are not V tops that we're looking for. The market sentiment line also continues to be extremely high, and again, it's hard for the market to tank when market sentiment is this high. In fact, if you go back and look at all the times we've been above 80, the market just doesn't tank very much. In fact, here, let me show you something really quick. So here we go. I've highlighted here with these rectangles all the times that the market sentiment line has spent a significant amount of time above 85, and so you can see there's some ups and downs, but no significant. I mean, that's probably the biggest down that we had right there. No significant trend changing weakness, and this one actually took off when the market sentiment's above 85, like we currently are. So while we might get a bit of a pullback here just because of how mature the posture is, no expectation of any kind of tanking, the market tanking right now. And again, like we talked about yesterday, there's still the possibility that this near-term line will bounce. This is a bullish area for it to bounce to. Just don't expect it to bounce to new highs. Don't expect that we'll push up these this intermediate high point or the 4-week range anytime soon. In fact, like I mentioned before, the odds of a bearish near-term high coming after this is getting bigger. Similar move you see on the Dow Jones Industrial Average. The Nasdaq outperformed today. There's a bounce, a close above that day's high point. We saw even close above that day's high. That's the lowest low point that we've had. Its near-term line is above 80, but still has a weak posture again. Hasn't altered the expectations that this near-term bounce won't get up to new highs. And the same thing here. Good, strong, bullish bounce here. Back up above this level, this 1515 level. But look at what the near-term line did. So weak bearish postures across the board. Near-term bouncing, but not a strong bullish bounce. Still, for most of them, aside from the Nasdaq, the other indexes, the near-term line still below the chart's midpoint. And considering the current postures, still the expectation is there. That will continue, that will maintain, that will kind of hang around here, and this intermediate line will get down below 50 or get around 50, and we'll just kind of meander within this. I'm not expecting anything significantly bearish for some time, but I also think that we've kind of run out of the bullish gas, so to speak, and we'll just kind of trudge around for a while. With one more day left in the week, you can kind of see how I mentioned yesterday that we could bounce up into the end of the week and kind of form one of these types of candles with a long lower shadow. That's still a possibility. Doesn't have to be red, right? If we get up above this 2642 tomorrow, then it won't be red. It will be, this will be white or dark depending upon how we fill in. You can see we can still be filled in here with a bearish candle because we opened up with a gap. We opened up to 2657. So we close anywhere between 2642 and 2657. It can be a filled in candle that's not red because of that opening gap. But still strong momentum here. And if we close, if this near-term rally lasts just today and tomorrow's jobs report sends us down lower and we get down here to this area, this 2620 area, then that's going to be a very bearish candlestick pattern. It would be a dark cloud cover candlestick pattern there. So keep our eyes tuned for that tomorrow. Again, considering the trend, I expect the former, not the latter. I expect another day higher tomorrow, but just like I said, not significantly higher. 3 green arrow standpoint, obviously the stochastics is down below its moving average. MACD is still holding above its moving average. It's moving average at really high levels. The MACD itself is at really high levels. And you notice, again, it's kind of hard to be too bearish when you're still holding the 8-day moving average and it's rising. In fact, all 3 lines are rising. So, again, you can see the bullish setup here, which precludes us from being significantly bearish. But we also don't have to be really bullish either. The odds of us bouncing up off of this and having this kind of move, or even move like this one here or this one over here, those odds aren't as high considering how bullish we've been to get to this point, and the fact that volatility is increasing to the downside up here. But this near-term bounce, we're not getting a bigger move off this low point. We're getting really small moves off this low. So again, it kind of shows that these bulls aren't really to come in and ready to buy this dip in force like they have in the past. All right, now let's take a look at the intraday chart, and you can see we did get up to a higher high. We got up to a higher low point here, closing up above the high. You see how we pulled back in the afternoon and closed up above yesterday's high point. So a bullish sign in that regard, but you notice here lots of room before we get up to a new 4-week high point. Also lots of room before we even touch. Remember, this is the midpoint right here. 260.50. That's the midpoint of the 4-week range. So I mean, look at all that room we have to trade in and to muck around in. And now as the range gets tighter and tighter, the 4-week range, then we start looking for moves to the downside. As of right now, there's no significant expectations of move to the downside because we're not even in the lower half of the 4-week range yet, much less testing that 4-week low point. But like I said, we're also, while we are trudging along in the upper half, we also are not close to the upper end either. We've really pushed it up higher here, and now we're taking a breather, a well-deserved breather. All right, so let's take a look at the range today, and the volume still 76 million, so still right above average. There's that we open and we close right at the same levels. You see the range here, 1.5 points after a 1-point range yesterday, 1.5 today. So 1.5 is still down below the average, which is good. We want it to bring that up. We want these lines to come back down to maintain the current trend. Not that I'm a perma bull, right, or a perma bear for that matter, but the trend is bullish. So if you're looking to maintain and ride a trend, then in order to maintain a bullish trend, you want to see these lines coming down here, and you can see the volume is right about average, and this 1.5 now. We don't want it to be. We want it to get down here. It's going to get. We want the volume in the trading ranges to get really small. That brings those lines down. It's really boring, but that's the kind of moves that leads us up. Although it's really boring, you get these kind of moves, and then it leads to sideways action for a while. You get boring moves, and you get, it leads to pretty decent runs, pretty decent intermediate runs. So that's kind of what we're looking for there. And then you take a look at the volatility index here. 1 second, there we go. Where is that volatility index? There we go. So the VIX, you can see, really dropped back down today. In fact, if I were to duplicate this now and bring it over here, turn this back to red, or to green. Now that that's done, actually this one is pending, so it needs to be blue. But you can see we're back down below 10.5 on an absolute basis in the VIX, and you can see the relative VIX to VXV is back down below 80%. So that's bullish. That's a good sign. And again, it doesn't change the fact that I'm not strongly bullish. I'm not expecting a month of runs here, of intermediate run like we just had. But it does show again. Don't be too bearish. It's okay to continue to ride a bullish trend. Just with the weakness, just pull back some of those positions that you've had into this, and on new positions, just trade smaller than what you normally do, and trade less aggressively, less directional than what you normally do, because the expectations aren't as big as to how much will go up as they were, say, 2 or 3 months ago. All right, now let's transition to what's driving the price action today. Of course, another reminder again here is my Twitter feed at DavidSettle42. A few things that I tweeted out today, and to make sure that you're getting these pushed out to you, for those that follow me, make sure you're liking and retweeting, including the Market Outlook tweet. That's always pinned to the top. The more you like and retweet this, the more Twitter will keep pushing you my stuff. The more, and then again, like I said, what I get out of it is that everybody who follows me gets pushed these tweets because of the engagement that you're giving us. So I appreciate that. And like I said, a few things. They're talking about that yield curve again, and the Fed funds rate, the expectations that the Fed's going to raise rates here. Here's the Fed funds effective rate. So the difference between the Fed funds effective rate and the target rate is what the Fed sets, and they say, okay, here's the rate that we feel that banks should charge each other for these overnight loans. Now, that doesn't necessarily mean the market is going to do that, right? If for whatever reason banks can charge whatever they want, but the Fed will try to influence with open market, the open market actions that it takes. But so the Fed funds effective rate will be around where the target rate is, but not always. And you can see right now it is, and it's most of the time it's going to be around there. But look at where it is now compared to the lowest point during this 2001 recession when the market dropped, and the Fed was dropping rates, all the way to about 2003. And then, of course, the Fed started to raise rates in June of 2004, which lasted for a couple of years, to right here, to June of '06. And you can see that's where the effective rate got all the way up above 5%. But you notice how these peaks, every time the Fed raises rates, these peaks are getting lower and lower and lower. So I don't expect, and you can see here, at least here, the high point got above the low, but it got above that low. It didn't get above this one. So we kind of went up and down. This was kind of our first higher low point in the mid 90s. Then we went up to that high. Then we came down and we peaked at that low point at 5.25%. You can see that peak, this area of peaks was about at that low point here. So, the trend is, just like in regular charts, that higher highs, higher lows, lower highs, lower lows, and it's like, a stair step. Each new low, it will be a resistance for the next layer. So we'll see, right now we're at that new low point. How high will we get? Can we get up to, this low point here, about 3%? In this range, between 1 and a little bit less than 3%, that's the most likely target for a peak that we'll get on the effective funds rate, which could be a while, right? Because again, I know the Fed, they're talking about this inverted yield curve, but this yield spread that they keep talking about dropped below zero in February of '06, and again, the market rallied higher for 20 more months, over 20%. So, and the Fed raised rates. They were raising rates from June '04 to June '06. So they actually still raised rates for a couple more months there. And like I said, the market continued to rally. So don't automatically assume that an inverted yield curve means the stock market's now going to be bearish, because that's not what past precedent has shown this. Otherwise, the calendar was really light today. We had jobless claims out. You can see kind of at the same levels they've always been, still low levels coming off of the hurricane season when we had the spike there in jobless claims, but back down to where we were, still very, very, very low levels for jobless claims. And that was the only real main economic release. The economic surprise index remains at very elevated high levels, which has an impact on interest rate expectations. You can see here, once this started to really take off, so did interest rate hike expectations, and they really started to take off there at the beginning of September. So GDP estimates will be released. We're kind of in this holding pattern for tomorrow's jobs number and the consumer sentiment survey, and you also see this wholesale trade will impact GDP estimates from an inventory standpoint, just like the trade balance impacted it earlier this week from a trade imports exports perspective. If we take a look at the sector, the different major asset classes, and make the chart darker so you can see the colors here. Crude oil, which has been very volatile, was our biggest winner today. Small cap stocks rebounded after really underperforming significantly the past few days, and you can see gold continuing to show significant weakness, and long-term bonds really coming down too. So really, from the time that the stocks, from the time that we had this peak in bonds and gold early in the morning, long-term bonds fell 1.2% on these, again, yields bouncing, and then gold dropping too, and crude oil rallying. So kind of a risk-on type of a move, but again, context, right? So in terms of the 2-week move, here's crude oil, which has been a significant loser over the past 2 weeks, bouncing. Gold continues to move lower, but you can also see, look at the move that small cap stocks have made from when was that Monday's open all the way to now. Small caps from Monday's open, small caps and crude oil were the biggest losers. They bounced up, and you can see long-term bonds were the biggest winner. They came down. And so ahead of tomorrow's big announcement, all we saw today was just basically a profit-taking type move. These are big moves in a matter of just 3 days, and so people are shaping positions, getting ready for potential news event risk with tomorrow. And of course, you also have the debt ceiling vote, which typically is a non-event, but who knows, right? At least it'll definitely be covered by the financial news as if it is a significant event, but usually isn't market moving. But that's definitely something I can keep an eye on. But really, the market's looking ahead for this jobs number to see how is that going to impact these rate hike expectations. This is March. This is the fact. This red line is the fact that we're going to get a rate hike in March, and then the purple line is the getting the rate hike in December and nothing more. And so is this line now going to get above 60%? See, nothing's been over 60% yet for this contract. Will the jobs number get above that? As that does get above that, it wouldn't necessarily cause a bear market, but it will dampen this bullish trend that we've had, and may be the impetus for more of a intermediate pullback if we get a strong jobs number. Of course, it might lead to more of a near-term bounce in the immediate, but eventually, as these rate hikes, this red line gets above 60%, then that will may be the cause of more of that intermediate pullback that we're expecting, simply because of how mature the current intermediate run is, and the fact that nothing goes up forever again unless it's Bitcoin. From a sector rotation standpoint, again, let's zoom out here really quick. Industrials, if I were to come again from the week, from the open of Monday, you look at consumer staples have had a really, really good run. They've pulled back. You can see that industrials, has had pullback, had been a good mover, but had pulled back down. They bounced the most. Materials have been pulling back down too. They bounced as well, and of course, technology was the biggest loser earlier in the week. It bounced up too, whereas you have healthcare, crude oil stocks, kind of showing that the bounce in crude oil may not be too trustworthy, because crude oil stocks didn't really bounce up significantly either. So safe haven areas, healthcare, real estate, utilities, lagging behind for this week. Again, that's not, it kind of shows this pullback here isn't that, major, significant of a pullback in terms of like falling off a cliff. Because, look at utilities and real estate and healthcare. They usually are up here with consumer staples, and they're lagging behind the broad market. So not really the most risk-off pullback, so to speak. All right, one of the stocks in the news today because of its earnings, you can see on the screen for our trade idea of the day, we'll take a look at Lululemon, of course. Big move higher today, 6.5%. For those of you who use the Likefolio app, you know that was one of the stocks they've been talking about heading into that earnings announcement as being very positive. Good call from Andy Swan there on this particular stock. But one thing that stands out to me is, we really broke out of the upper Bollinger Band. When you gap that significant out of the upper Bollinger Band, the upper Bollinger Bands are kind of standard deviations of volatility, 2 standard deviations of volatility around the line here in the middle, the 20-period exponential moving average. So, you can see that's a big breakout in terms of what this stock has normally been doing in terms of how it's been trading. When it's done that in the past, in fact, it did this last year on its earnings announcement. In fact, it broke way outside of the Bollinger Band, and then it couldn't get going any further beyond that. And you can see it actually kind of came down a little bit. Here, you can see how it came down, and then for about another month and 6 weeks or so, it stayed up above that level. So you can see how big gaps outside of Bollinger Bands, are hard to sustain, hard to maintain. We've seen here's another one over here, a big gap outside on an earnings to the upside, and it couldn't get going anymore. That was about to peak. So that being said, we can say, okay, well, what if we were to take a look at selling a call option up above there? Of course, this would be one of those riskier trades because it goes against that move. So it doesn't mean we can't do this. It just means position size smaller than what you normally do when you are going with the trend. In this case, a bullish trend, stock going to the upside. But what we're trying to take advantage of is it went too far up to the upside. That there's not going to be a lot of momentum to keep it going, and there's opportunity there based on what we've seen in the past. I mean, that's a traditional pattern using Bollinger Bands in any stock, much less what we've seen on this particular stock, especially on its earnings, especially on this particular earnings, the December earnings here. So we say, okay, well, if I were to sell this 75 call option here and then protect it in case it does keep going up to the upside with this 77.5, then I get a pretty decent credit. And if you notice, I've got decent odds of success, not accounting for the fact, just accounting for current volatility levels. There's a decent odds that will stay below the break even by expiration date. But of course, add in the fact that we gapped up to this point from down here, and that's way outside the Bollinger Bands, and that increases those odds even more. Not to 100%, because nothing ever is, and that's why we want a position size, and in this case, position size, again, smaller than what you normally do. But you can see there's your credit, there's your break even, and there is, if you take a look at the break even on the chart, there's the break even on the chart, again, higher than the last time we gapped up to this level here. So decent trend. But did we go too far up? Are we going to now go sideways? In this case, for our expiration month for the next 43 days. So we're talking about, again, about another 6-week period. And if we do, even if we just go up a little bit, as long as we don't go up above 75, right here, which is where the strike price is, then we're fine. And if we do go up above 75, remember, we're trying to get $65 here per spread. If we do get up above 75 right now, if we hit that break even right now, then we're going to be down, we're going to have a $51 loss. In which case, that's a pretty decent reward to risk ratio. So as long as we stay above this 76.25 area, then time decay is going to work for you. And that's about a $60. I mean, that's about a $60 loss there too. So that's about a 1-to-1 reward to risk ratio. That's not bad considering a high probability trade. If it gets above 76.25, time decay will start working against you and bring this purple line down. And we don't want to be in this. So that's kind of your level to say, okay, don't want to be in this trade anymore. Time decay is not working for me anymore. Then essentially it's a long put. This trade turns into a long put on a trade that's on a bullish trend, the stock's taking off. So at that particular case, we say, okay, we'll just take our small loss, easily a loss, compared to our gains. What we don't want to do is take the $185 loss, because that's not worth it. No trade is worth taking a loss that's 3 times as big as what your potential reward was. So we got to have a way to get out, and there's our way. When that line crosses that midpoint there, when time decay starts working against you, knowing that there's really no resistance up here, so otherwise we'd have some kind of resistance level to tell us. So there's no resistance up there, so we'll just say, okay, if we get above this crossover point, we'll take our $50, $60 loss or whatever it is at that, because it's, according to the green line, no matter how close we get to expiration, that's about where the loss will be. So we don't have to worry about time hurting us right now. But after that, it will. So that will be our point that we say, okay, we'll take our small loss, move on to another trade at that point. So to summarize, we started to get the near-term bounce that we talked about for the last couple of days, and of course it wasn't very significant of a near-term bounce. So while the trend and the posture and the long-term trend is still significantly bullish, there is some weakness showing up that would suggest, not that we're going to tank and start heading to the downside significantly now, but it's starting to suggest that the bullish trend is going to end. And remember, there's more than up trends and down trends. There's also sideways trends. And at the very least, this bullish trend should, based on this weakness, based on the time frames we're seeing, should start to convert more into at least a sideways trend. Of course, anything can happen, and we could, continue to move higher, right? But especially if fiscal policies continue to ramp up this investor sentiment. But from a technical perspective, take everything out and just look at the market forecast indicator and our expectations and what some of the other charts are telling us. We've been bullish. This is significantly bullish, and now the market's looking for a breather. And so one extreme of that is today's trade idea with the stock. Big extreme move to the upside, and now there's expectations based on the technical patterns for a breather. And so today's trade idea tries to take advantage of that. So again, thanks for watching tonight, everybody. Remember to subscribe, like, and comment on the YouTube channel down below. Remember also to follow me on Twitter for more content and to like and retweet the content you do see from me there, including the Market Outlook tweets, so that Twitter keeps pushing to you all my stuff that I put out there. And also remember, if you haven't already, to join our Facebook our Market Outlook community on Facebook with the link that's down in the description below. So again, thanks. Have a great evening, everyone, and we'll see you all tomorrow.